Okay. Reminder that your case is due before class next Wednesday, because we'll talk about the case during the class. So it's a group case. Make sure you turn in one report for the group. And if you haven't started working on it, what are you waiting for? Right? It's there. So today we're going to complete our discussion of the Disney theme park, the Rio Disney. And if you remember in the last session, we started with accounting earnings, right? We computed return on capital. And on the return on capital basis, the project did not look good. But I qualified the answer by saying, but I'm stopping after 10 years. And that's not fair to a project that can continue for 50, 60, 70, 100 years. We started cash flows. What are the three adjustments we need to make to cash to get from earnings to cash flows? One is subtract out changes in working capital. Okay. What are the other two? Subtract out CapEx because it's a cash outflow and add back depreciation and other non-cash charges. And even though it looks like depreciation leaves no imprint, it leaves a tax benefit. So that's why we have to go through the process of subtracting it out first and then adding it back. So we now have cash flows of the project. We're one step closer to a good measure of return, right? We've gone from earnings to cash flows, but we want incremental cash flows. So what the heck does that even mean? I'll give you the basic two questions you need to ask about any line item to decide whether it's incremental. Ask yourself what will happen if you take this project. Then ask yourself what will happen if you don't take this project. If the answer is the same, it is not incremental. It sounds mysterious, but let me take the cash flows I had and pick on a couple of items that I think should not be in there. Remember the $500 million that Disney had already spent on this theme park? How did I describe it? You're not going to get the money back even if you reject the theme park. So let's ask the question. What will happen to the $500 million you've already spent if you take the project? It's been spent. What will happen if you don't take the project? It's been spent. This project is going to have no effect on the $500 million. So here's what I'm going to do. I'm going to take it out saying, hey, it's not an incremental cash flow. It's going to be there anyway. And when I take it out, I'm also going to take out any imprint it leaves on the cash flows, because remember, I depreciated that. I'm going to get that depreciation anyway. So I reverse that expenditure because it's going to be there no matter what. Second, if you remember, I allocated G&A costs. And when I allocated the costs, I also was open about the fact that 2/3 of these expenses have nothing to do with the project. So let's ask the question of what will happen if I take the project. That 2/3 will be allocated to this project. What will happen if I don't take the project? That 2/3 will be allocated somewhere else to the company. That cost is going to be there. You're not firing people in Burbank because you're not taking this project. So I add back that non-incremental allocated expense saying, hey, it's not a result of the project. Again, you have to clean up for the residue because when I subtracted that expense, I created a tax benefit. I reversed both the expense and the tax benefit to get to an incremental cash flow. It's a pain in the neck, right? Because I did the accounting statement first, and now I'm reversing what the accountants did. I'll give you a much more direct way to get incremental cash flows that I think is much more intuitive. Instead of looking at what accountants tell you should do, why not focus in on just the incremental item? So if you look at this statement, what I've done is instead of subtracting out the allocated G&A, I focus on only the incremental items. It's a great way of checking to see whether your numbers are right, is do it both ways. So here, instead of subtracting the allocated G&A, I subtract the incremental G&A. I ignore the sunk cost. And if you look at these cash flows and compare them to the previous page, I get exactly the same answer because the end game is the same. So this seems simple enough. We teach it in every corporate finance class. The costs, like the $500 million you've already spent that you're not going to get back, we call, what's the buzzword we use in finance when you spend something? It's called a sunk cost, right? And every textbook says, if you have a sunk cost, it should not affect your decision. But let's be real. Let's say you stand in line because you see a line of 15 people in front of you. You stand in line to get a ticket. You think it'll take you 10 minutes. 20 minutes later, there's still 8 people in front of you in the line. You know you should leave now, right? But a part of your brain that you waited 20 minutes already. You're going to waste the 20 minutes if you leave now. So guess what you do? You spend another 40 minutes staying in line to get something you wanted to spend 15 minutes on. It's very difficult to ignore sunk costs. In theory, we can say ignore it, but it's very difficult to ignore it. In fact, there's one of the most famous experiments run of all time. The scientist took two groups of people, and he gave them the description of a project. He said, look, we're an aircraft company. We're building the supersonic jet. And for both, in both groups, the actual forward-looking numbers were the same. This jet was now outmoded. A competitor had come up with a much better jet. It really didn't make sense to actually develop the jet, given how much more they'd have to spend. With the first group, he just mentioned how much money had already been spent developing the jet. With the second group, he did not mention that. So the second group did the right thing. They said, don't develop the jet. It doesn't make sense. But the first group, because of that mention that you've spent $2 billion, actually went ahead with developing the jet. You can't fight this. It's psychological. My advice to you is if you're in business and you have to present a project, don't tell me a lot about what I've already spent before telling me about what the future will bring, because what that first part of what you said will often sway what I end up doing. That's a sunk cost effect. If you get a chance, take a look at yesterday's puzzle. It's very personal. Did anybody look at it? It's about your decision to come to Stern to get an MBA. How much is it costing you per year if you count the opportunity cost of the job you left behind? Kind of money. I won't even say how much, probably depressing. And why are you doing it? Don't tell me you came here to learn. I know that that's part of the output. I mean, the MBA is a very pragmatic degree. It's not a master's in psychology. It's a master's in business. And why do you get it? Because you hope to get a pay jump or a switch in career after this. So basically, this lays out the fact that you're now 1 year into the program. They collect tuition at the start of every semester, right? They don't wait. It's not the end of the period payment, start of the NY is very good at that. So you've spent the first year's amount already. Let's say at this point, you look at the career prospects out there and you say, this isn't going to get me a bump up in pay. And the logical thing to do now is drop out, right? Why spend another year of tuition if it's not going to do it? But I'll wager the fact that you've already spent 1 year of your life and $150,000 or $200,000 is going to affect that decision. So this is an issue that companies face, especially when it comes to things like R&D. In the old days, when pharma companies had pricing power, they could do whatever they wanted. Here's how it worked. You'd spend money on R&D or test marketing. In this case, let's assume that you've already spent $100 million test marketing a product. So now you got the information to assess whether to take this project. You sit down, you project your future-looking cash flows, and you come up with the net present value for this project of $25 million. You've already spent $100 million doing the research, but this project will add about $25 million value. Would you take the project? If you don't take the project, what's going to happen? You lose $100 million. You lost it already. If you take the project, what's going to happen? You lost $100 million, but at least you have a chance of making $25 million back. Would you rather lose $75 million or $100 million? That's kind of, don't answer that question. I don't want to hear the answer if it's the wrong answer. The answer is you'd rather lose $75 million. That is the argument behind looking at incremental cash flows, is even if in hindsight, you look back and say, I shouldn't have done that. The reality is you've already done it. You're not going to get that money back. So as you look at this kind of project, you've got to be careful, because if every project you look at as a company has these characteristics, you spend $100 million upfront, you get $25 million back, you're not going to be a company for very long. You're going to crash and burn. And this is the challenge that pharmaceutical companies faced with R&D. In the old days, when you had pricing power, you could give the R&D department $5 billion, And you know what you do? You take the 5 billion, you pass it through into pricing of your successful products, you cover the 5 billion. But as the business becomes more competitive, pricing power decreases, you can already see that if you wait until after the R&D is done to ask questions, it's always too late because the money has already been spent. So the culture is changing, but it's changing slowly because companies, the older pharmaceutical companies are used to just giving money to R&D and saying, I can recoup that in my successful projects. But that might not be the business model that works anymore. And you're seeing this in the shift in pharmaceutical companies from doing R&D internally to buying R&D that other companies do. Young companies that develop a product, they go to Merck, they sell the entire company with the product. So any questions on sunk costs? It's something that I think is, and when I look at sports, you see this phenomenon play out, right? I mean, I remember when A-Rod was signed for 10 years and $275 million by the Yankees. By the time you get to year 5, you know that this is a horrifically bad mistake. But if you're Brian Cashman and you're the person who made that mistake, you can't step away. Sometimes acknowledging sunk costs is difficult if you were the decision maker who created that sunk cost, because the minute you admit you're admitting to a mistake. This way you can let it ride through the end of year 10, act like it never happened, even though you wrote out $27.5 million checks every year. So when you see big decisions that cost a lot of money, you're saying, why do you keep digging the hole deeper? The answer is because that psychologically you're attached to the fact, I've spent so much money and time, I can't give up now. Let's talk a little bit about allocated costs. Now, allocated costs, as I said, are costs which are with no revenues, or allocating them to businesses. And often those costs, are going to be there anyway. It's allocated doesn't mean they will go away. And often when you look at big companies, one of the questions you have to ask is how much of that G&A cost is at least indirectly related to revenues, and how much of it is truly fixed? You're saying, how the heck am I going to know that? Because when you look at a company, any company, they give you a G&A cost, it's a big number. They don't tell you how much is fixed and how much is variable. Is there something I could use to gauge how much of my G&A cost is fixed and how much is variable? What's the essence of variable? It tends to move with your revenues, right? So if I gave you 10 years of data, in this case, let me give you 3 years of data on a company, and I want you to guess how much of the G&A costs of this company are fixed and variable based on 3 years of data. So I've given you the revenues every year, the G&A cost every year. You can see as revenues grow, G&A costs grow, but they grow less than proportionately. Is there a way you can use that 3 years of data to estimate how much of the $300 million is fixed cost and how much is variable? I've actually made the example simplistic, so you should be able to do it. What is the clue you can use to make that judgment? Yes. So take the change in revenues. How much my revenue go up by 200 million? How much my G&A costs go up by 20 million? Play a game. Let's assume that revenues go to zero. It's COVID 2020, right? The entire business shuts down. Your revenues go down. If the pattern applies, if your revenues go from $1 billion back to zero, that'll save you, because you're getting about, for every 200 million, you get 20. That's $10 for every 100. Your G&A costs are going to drop by $100 million. So if your revenues go from $1 billion to zero, you've lost all revenues, your G&A costs are going to drop by $100 million. You think, so what? You take $100 million out of $250 million, you're down to $150 million, but you're still spending the $150 million even though you have no revenues. This is the Marriott and the Hilton problem in March of 2020. You had to maintain the hotels, you were paying people. That's a cost that's not going to go away even if the revenues go to zero. That's a fixed cost. So if you have enough years of history in your company and G&A costs and revenues every year, you can at least try to guess. It's never going to be as simplistic as this. Based on the change in revenue and change in G&A, how much of the costs are fixed and how much are variable? Yes.
Companies can they estimate the sunk cost, or that's something that
if it's going to be a sunk cost, if you're estimating forward, it's not a sunk cost. It's a forward-looking cost. The essence of a sunk cost is you've already spent it.
Okay.
Okay. So the nature, it was estimated by somebody before it was spent. So before it was spent, it was actually a forecasted get. But once you've spent it, it's gone. You can't get it back. The essence of a sunk cost is it's a past cost. It's a cost you've already incurred. And now you might regret it, but regretting it is not going to get it back for you.
Forecast there's some cost that the project will stop at a certain.
They forecast their costs. All costs become sunk costs. Not all sunk costs are bad, right? Because if you have a great project, your sunk costs create enough revenues. The sunk costs you regret are the sunk costs that did not pay off. So the way to think about this is we do forecasts of revenues and costs. If the revenues come in as expected, the costs come in as expected. By the time you get to year 10, your costs are all sunk, your revenues are all, you can see what they are. You have no regrets. But you could have spent all the money. If your revenues don't come in as expected, you have a sunk cost. We said, I wish I hadn't done that. So we've gone from cash flows to incremental cash flows. We're almost there. What's the last thing we need to do? We need to time weight these cash flows. Time weighting is just discounting. As I said, when you discount a cash flow, you're time weighting the cash flow. You're saying a cash flow in year 10 is worth less than the same cash flow today. So discounting brings them back to today. Compounding brings them to the future. Okay. 80% of finance is discounting and compounding. That's why that present value button in the old calculators used to get worn out, because you used it over and over again. Silicon Valley Bank had a discounting problem, right? You take a bond, you buy it at a 1.7% coupon rate, the market interest rate goes to 4%. The present value of exactly the same cash flows you had 6 months ago is now 18% less because the time-weighted value is decreased. So when you think about time-weighting cash flows, there are two techniques that you use in capital budgeting to do a time-weighted cash flow return. The first, before I do that, this is something I'm still attached to, though most people, because they have calculators and spreadsheets that do it for you, have left it behind. I still don't trust the present value function in Excel. This is just my age, I guess. So I actually do it myself. It always works out to the same number, but after 40 years, I still don't trust it. So just in case you are like me and you don't trust a present value button, these are the equations for present value for any cash flow you can run into. Let's start at the top. You have a single cash flow in the future. $10 million 10 years from now, how much is it worth today? You take the 10 million, you discount it back at whatever discount rate, 8%, 10%, 12%. That's a single cash flow. Second is an annuity. I just described the Silicon Valley Bank investment in treasury bonds. When you buy a T-bond, what are your cash flows going to be? There's a face value you get at the end, but while you hold it every 6 months, you get a coupon. That coupon was based on the 1.7% that they bought these bonds at. If you ask me, what's the present value of that coupon over the next 10 years, you have an annuity. The essence of an annuity is you get the same cash flow every year for the lifetime of the asset. Bonds always have annuities. In equities, you usually don't get annuities because cash flows change, they're not the same, but with the bond, it's an annuity. You can also have what's called a growing annuity. It's an extraordinarily useful equation. Now, what's a growing annuity? Let's assume I own a gold mine. I don't, but let's assume I do. And I got cash flows of $1 million last year. And I tell you, I expect these cash flows to grow at 2% a year for the next 25 years, and there's no more gold left after year 25. And ask you, what is the present value of the cash flows on this gold mine? There's a long way to do it, right? Which is project out cash flows in year 1, year 2, year 3, year 4, year 5, discount each cash flow back to today at the discount rate, add them all up. That'll always work. But remember, you're only 30 minutes on the quiz. So if I gave you a quiz of what's the value of these 25 years of cash flows, don't do that approach because you're going to run out of time. Here's a shortcut. If you can tell me what your cash flow is, in this case, $1,000, the growth rate of 2%, what your discount rate is, I promise you, and you can check it out if you want, that if you take those 25 years of cash flows and apply this growing annuity formula, you will get exactly the same present value. Saves you time. So you've got single cash flow, annuity, growing annuity. Now I'm going to terrify you. An annuity can last 25 years, 50 years, even 100 years. A perpetuity lasts forever. We live in a world forever has lost all of its meaning. Who believes that ever going to mean climate change and the earth might not be around? But let's say you're still an optimist. If I promise you a cash flow every year in perpetuity, first, I need to have the capacity to do that, right? There were bonds issued by the Canadian and the British governments. This was about 100 years ago when people were much more optimistic about forever, called console bonds. You know how a console bond works? You buy a console bond, the coupon rate, let's say it's set at 3%. Typically, bonds have a face value of 1,000. 3% of 1,000 is $30. In a console bond, you will get $30 every year forever. You see, I'm not around forever. Your descendants and their descendants can get it. It's a perpetuity. What's the present value of a perpetuity? It's the simplest present value equation of all. You take the $30, you divide by, let's say your discount rate is 4%. $30 divided by 0.04 gives me $750. I would pay $750 for a console bond that pays $30 every year forever if the market interest rate is 4%. And if a perpetuity scares you, a growing perpetuity should terrify you. Because not only are you assuming forever, but that your cash flows will grow at 2% a year forever, or 1% a year forever. If you've ever done discounted cash flow valuation, this terrifying equation is what we assume when you get to year 5 or 10 in a company valuation. Beyond that, what will happen? This company will keep growing forever. And with a growing perpetuity, the present value of all of those cash flows forever can be captured by looking at the expected cash flow 1 year later. So if you're doing a value in year 10, you got to project out the cash flow in year 11. That's something all present value equations require. And dividing by the difference between the discount rate you're going to use and your growth rate in perpetuity. And the reason this is one of the most terrifying equations in finance is take a look at that equation. Numerator is the cash flow. What's in the denominator? R minus G. So let's say your discount rate is 10%. You start with a growth rate of 3%. You come up with a value, you don't like it. It's too low. Then you try 4%. It's going to get higher, right? Because the numerator stays the same. Then you try 5%. Then you try 6%. You see where this is headed? I call these Buzz Lightyear valuations. Because as G approaches R, what does the value become? It's going to approach infinity, and then you're going to go beyond. I don't even know what's beyond. I don't want to see what's beyond. So when you use this equation, you got to be very careful, because if you're assuming your cash flows grow at a constant rate forever, that growth rate comes with a cap. It cannot exceed the growth rate of the economy you're in, because if it does, the whole equation blows up. These are all of the present value equations you will ever need. So if you have a scientific calculator rather than a financial calculator, you can program these in. And no matter what kind of sets of cash flows I give you, you should be able to come up with the present value. But assuming you have these tools in your toolkit, there are two ways in which you can compute a time-weighted cash flow return. The first is called the net present value. The net present value, here's what you do. I give you cash flows for the next 10 years in a project. You discount them all back to the present, and you add up all of the present values. You're going to come up with a sum. If that sum, that net present value, is greater than 0, you should accept the project. And you know what? I still have CFOs who wrestle with this problem. And I'll tell you what the basic conundrum is. Let's say you have a project that costs you $5 billion, and your net present value is $5. Sounds absurd, right? Why would I invest $5 billion to get a $5 return? He said, why would I do that? Why should you still do that? You'd rather make $15 billion as your net present value, but let's say you could make only $5. Why is that still okay? What is the net present value measure that allows even a $5 net present value to be okay? I'm sorry, what is it?
Measures against your next best alternative.
And in fact, you capture that it's not even your next best alternative, it's your investors' next. Your next best alternative might be horrifically bad. It's what your investors could do with the money. Remember, this is over and above your cost of capital. And that cost, this is why we need hurdle rates before you start doing capital budgeting. So net present value of $5 basically means you're making your cost of capital. Remember, for Disney, it was 8%, 9%. You're making that plus $5. You're saying, it's only $5. So if you don't take the project, what do you plan to do? put your money in T-bills, in which case your net present value is 0. 5 beats 0 as far as I can tell. So net present values are positive, you will take a project. Net present values are negative, you should reject the project. I'll give you exceptions to those rules, but that's the first way in which you can do time-weighted cash flow returns. But people, as I said, wrestle with net present value. They don't like it. And there's a simple reason. I don't know how many of you have portfolios, but Stern might have extracted all your wealth. Does anybody have a portfolio they can talk about? Okay. You don't have to tell me something, but if I ask you, what return did you make on your portfolio last year? You know, the answer you almost always get is a percentage. Nobody says, I made $18,000. They say, I made 18% or I made 15%. We think in percentage terms. It's much more intuitive. That's why we like return on invested capital, right? It's a percentage return. There's a time-weighted cash flow return analog to accounting returns on capital. Where instead of using earnings, I use cash flows. I use incremental cash flows and ask a very simple question. What discount rate will make my net present value 0? In other words, I try 8%, 9%, 10%. Let's say at 11.5%, I come up with a net present value that's 0. That's called an internal rate of return. You're saying, what do I do with it? You compare it to your cost of capital, the hurdle rate we talked about. You get exactly the same answer if you have a standalone project. We'll talk about when they can give you different answers, because it too is a time-weighted incremental cash flow return, NPV or IRR. So with that lead in, let's talk about, go back to the project. Remember, I stopped after year 10 and I waved my hands and said, I wish I could do more because this project can last after year 10. And with accounting returns, it was very difficult to bring in what happens after year 10. But with cash flows, I can. There are two choices I have at the end of year 10. The first is to liquidate the project. What does that mean with a theme park? Shut the theme park down, sell the pieces off on eBay. I mean, somebody's going to pay for a piece of the Dumbo ride. No, I have a Yankee chair I bought from the old Yankee Stadium. It cost me an arm and a leg, but maybe that's what Disney can do. End of year 10, they shut the theme park down, they sell off the pieces. That's called salvage value. In many companies, that's basically the only end game. But in the case of Disney at the end of year 10, you have a thriving theme park making lots of money. There's a second alternative, which is let the project run, let the park continue. For how long? I'm going to initially assume forever because it makes my life simple. I'll talk about the pushback I got when I presented this to the Disney theme park people because they said, that's not realistic. I agree. But in this case, to start, I assume that beyond year 10, the project continues. That's called a terminal value, basically capturing the value of what this theme park will be if it continues forever. I assume that the cash flows will grow at the inflation rate. You're saying, why do you just stop at inflation? If I allow growth to be higher than inflation, what am I doing in this theme park? Allowing more people to come into the park, right? And this keeps increasing by 3% or 1% or 2% every year. I was in Disney World last week. And in Magic Kingdom, you couldn't move, right? It's so crowded. You see what's going to happen. If I let this theme park grow in real terms, it's going to blow up on me unless I keep making the park bigger. And because I don't want to invest more, I'm going to let the growth continue at the inflation rate. So what that effectively means is the number of people gets capped in year 10 coming to the theme park, but ticket prices will rise at the inflation rate. And that's, I think, a pretty realistic assumption for a company like this. So 2% growth rate forever. So let's plug it in. I estimated the cash flows in year 11. That's $715 million is my cash flow in year 10. I grew it out 1 year at 2%. That's the inflation rate. Divided by the cost of capital that we estimated for this theme park, 8.46% minus 2%, gives me $11.275 billion as my terminal value. It's the elephant in the room because if you look at my cash flows in this project, there are my cash flows for the first 10 years. There's the elephant in the room, $11.275 billion. So when I presented this to the Disney theme park people, of course, they latched on to the $11.275 billion. They said, what does it even measure? Can you give me an intuitive explanation for what the $11,275 million captures? Yeah.
You took all future cash flows, everything will give you in the future and just.
But I want to give it to them in terms where I don't have to use cash flows and present values. It's okay, I get that. What would happen if Disney sold the theme park, lock, stock, barrel, and Mickey included? You see why Mickey has to be included, right? If I take Mickey out, it's not going to be worth 11,275 million. There's no way Disney will ever do this. But if they did that, this is what somebody would pay for the theme park given the cash flow, because by then it'll be a mature theme park growing at the inflation rate. That's what the terminal value is. What do you think your business is going to be worth to somebody who cares about cash flows and pays based on cash flows? Is that tilting my decision? Absolutely. You bring that in because you're now bringing the forever in and you take the present value. The net present value you get for this theme park is $3.3 billion. What do you say about NPV? If it's greater than zero, it's a good investment. And once I've brought in the terminal value, the net present value turns positive. And you can see the terminal value that makes the difference. So when I finished this, one of the people in the group said, but you've assumed forever. I know theme parks last a long time, but nothing lasts forever. I said, what? Give me a life for the theme park. And he said 75 years. You know what the net present value would be if instead of using a growing perpetuity? Remember I had a growing annuity? If I'd use 65 years of cash flows after year 10 with a 2% growth rate and used a growing annuity, this number would have been $10.9 billion. In other words, I'm almost at 11,275 with a 75-year life. The reason we use perpetuities in valuation and finance, it's not because we're unrealistic about the world lasting forever. It's once you get past 50, 60, or 70 years, you might as well use a perpetuity. The value you're going to get is going to be roughly the same as using a 60-year period after that. So the net present value of this project is 3.2 billion. Let's put some intuition on it. What does it mean? Basically, it first tells you the project is a good project. But net present values have some added value in analysis. The net present value of a project becomes the value that will be added on to your company if you take this project. So let's say your company worth 30 billion. You go take a project which has a net present value of 3.2 billion. Your value as a company will go from 30 billion to 33.2 billion. Your price might not go up because if everybody expects you to keep building great theme parks and but your value will go up. So stay in with me. If I have a company with a value of 30 billion, it takes a project with a net present value of 3.2 billion, the value goes from 30 billion to 33.2 billion. Let's say this company takes a project with a net present value of 0. What happens to the value of the company? Kind of hang in there. It's kind of obvious. Well, taking the project 0 will leave the value at 30 billion. You did nothing. What if the company goes out and takes a project with a net present value of -5 billion? You see, who'd be stupid enough to do it? Every year, there are at least a few hundred companies that are stupid enough to do it. And we'll talk about what kind of action creates this kind of negative net present value. But if you have a company with a $30 billion value, it goes and takes a project with a net present value of -5 billion, its value is going to go from 30 billion down to 25 billion. Now, let's look at the kind of massive stupidity that can give rise to a negative net present value of -5 million. It's very difficult to lose that much money on projects, right? Projects are too small. So what kind of project would you have to take which has a potential to create this negative net present value? Buying a company. I'll give you, keeping it personal with Disney. You know the worst investment Disney has made in the last, probably over its entire life is? It's not the Star Wars acquisition, which was 4 billion, or the Marvel acquisition of 4.5 billion. It was buying Fox for, what, $70 billion? My guess is they probably overpaid by 8 billion. They probably wiped out 20 years of hard work on one day. I'm cynical about acquisitions. I do a session on acquisitions called Acquirers Anonymous, 7 Steps to Sobriety. Because it's an addiction. Because once you start to grow with acquisitions, it becomes very difficult to go back to growing by taking individual projects which are small, right? It's so much work. And think of how much the CEO's ego is stoked by doing a big acquisition. You're in the news, everybody's talking about you. Every time a company overpays on an acquisition, it's coming out of its value. You see, that doesn't happen. It does. You know, in 55% of all acquisitions, the acquiring company's stock price drops on the day they do the acquisition. When Microsoft bought Activision, its market cap dropped by $3 billion that day. They might eventually come back and recoup that and say the metaverse is worth at least that $3 billion. But on the day of the acquisition, investors looking at Microsoft, their judgment was, you overpaid. So the next big acquisition, I want you to look at the acquiring company stock price. Don't look at the target company stock price. Nothing interesting is happening there other than a jump of 20%. Look at the acquiring company stock price because it'll give you a gauge of what do investors think about this acquisition. So that's the net present value. Any questions about NPV and what it tells you? Yeah.
Does it mean, like, a detour on this topic? Does it mean UBS's stock price will go down?
It did. Did you look at its market cap yesterday? So, but in the sense, they also got a bargain basement price. It's telling that they got this $3 billion acquisition for a company that had a market cap of 30 billion, and the stock price is still going down about what people think UBS is actually, Credit Suisse is actually worth. You know what investors are building in, right? The expectation that Credit Suisse has a negative value, that what you're getting is bags of trouble, and it might not, even at zero, you might not take it. Nobody will buy GE Capital. GE can give it away. They've tried. Nobody will take GE Capital. Too many entanglements, too many costs. So even at zero, sometimes you might be paying too much. So let's talk about internal rates of return. You know how you get the IRR, right? You hit the IRR button on your calculator, or you do the IRR function in Excel. I don't like it. I don't like it for lots of different reasons. So I'll give you a more creative way, a more useful way, a more visual way of computing IRR. What did I say the IRR was? That discount rate that makes the net present value zero, right? So here's what I did. I took the cash flows of this project and I tried different discount rates. I started at 8%, then I went to 9%, then I went to 10%, then I went to 11% and 12%. It's called a net present value profile. And not surprisingly, in this project, as the discount rate goes up, the net present value decreases. Most projects, that's going to be true. There are some projects where cash flows are at, your negative cash flows might be the end, but those are exceptions. What am I looking for? The point at which my net present value is zero. There it is. My internal rate of return for this project is 12.6%. What do I do with this? What do I compare it to? My, what is it? Somebody said something back there. Yeah.
Is it hurdle rate?
And what is my hurdle rate? Do you remember from the previous page? It was about 8.5%. So the 12.6% beats the 8.5%. I take the project. I'll tell you why I emphasize that. I've heard CFOs say they don't use net present value. They use IRR because they hate computing costs of capital. To which my response is, so once you get the IRR, what do you do? Compared to a made up number? That's effectively what they end up doing. If you're going to use IRR, you need the same information. So if you're going to use IRR, do it for the right reasons, which is, I like a percentage rate of return, not because you need less information. You still have to go through bottom-up betas and cost of debt and cost of equity and cost of capital, because that's how you come up with a hurdle rate. But I want to stay on this graph. See the slope of that line? If I ask you to intuitively explain, what is the slope of that line, the net present value line, tell me. What is it telling me? How sensitive my net present value is to changes in my discount rate, right? I don't know whether you remember from foundations, this notion called duration. What is a bond duration measure? It measures how sensitive a bond price is to change in interest rates. Think of this as the equivalent. It tells you something about how sensitive your project is to change it. You're saying, how do I use it? Let's say Disney has two projects. No, and they're mutually exclusive. You can pick one or the other. They both have net present values of 3.26 billion. But one has a steeper slope than the other. So let's say I put both slopes on it. They have the same NPV. Given what I just said, which one would you rather take as this? The one with the steeper slope or the lesser slope? You take the lesser slope because the steeper slope would suggest there's more duration risk in that project. So that's the reason I like net present value profiles. It's not just giving me an IRR, it's giving me a sense of how sensitive is this project to changes in my discount rate. So that's the NPV part. Let me re-emphasize. When you do internal rate of return, you most of the time you come to the same conclusion as you do with NPV. We'll talk about the times when they will give you different answers, but I'll at least lay the foundation. A project can only have one net present value. You take the cash flows, you discount them. A project can have more than one internal rate of return. Sounds like a strange thing, but kind of file that away. It can potentially be a problem. It's got to be there's certain types of projects where this will happen, but you can have more than one internal rate of return. The net present value is a dollar value. It gives you 15 million, 20 million. The IRR is a percentage return. And finally, there is an assumption about the cash flows we get in year 1, year 2, year 3, year 4, year 5 that we'll come back and revisit. In the net present value approach, we assume that those intermediate cash flows get reinvested at the cost of capital. The IRR approach assumes that those intermediate cash flows get reinvested at the internal rate of return. So in this case, what am I assuming with the net present value approach? I'm assuming that cash flows that Disney gets from this theme park in year 1, year 2, year 3 get reinvested at the 8.46% cost of capital. But with the IRR approach, I'm assuming they can get reinvested at the 12.6% IRR, which do you think is the more dangerous assumption? I mean, let's suppose this project had a 50% IRR. What am I assuming? That not only is this project giving me 50, but I have an infinite stream of projects just like this one, which can deliver 50%. Private equity guys love internal rates of return. What they will never talk about is the intermediate cash flow assumptions, because even if your cash flows are right, you get a 32% IRR, you're overstating what I'll actually make on this project, because those intermediate cash flows are not going to deliver the same 32% return you claim I will make on this project. We'll come back and look at that intermediate cash flow assumption, but I want to tie up some loose ends on this particular project. Remember when I gave you the numbers for this project and I was your number cruncher, I said, I'm going to cheat. It's a project in Rio, but I'm going to give you all the cash flows in US dollars. It's cheating because the cash flows are actually going to be in reais. So I'm going to ask you a generic question. Let's assume I've done everything in reais. My cash flows, my discount rate. The project looks good on a US dollar basis, right? Would your result or conclusion be different if I did everything in reais? Let's break it down. My dollar cost of capital is 8.5%. If I'd done the entire analysis in reais, what would my cost of capital look like? A higher number or a lower number? It's going to be higher. And why? No, country risk is already in my dollar cost of capital, right? So when you do dollar cost of capital, I brought it in through the equity. It's inflation, right? So let's say it goes to 50. This is terrible, right? Higher discount rate. But if I do everything in US dollar, in real terms, it's not just my discount rate that's changing, it's also my cash flows. Remember the growth rate I used in perpetuity? 2%, which was the inflation rate in what currency? In US dollars. If I do everything in reais, that growth rate is no longer going to be 2%, it's going to be 9%. Untenable if it's a dollar valuation, but in reais, much higher growth rate. I know you don't believe me on this one, so I'm going to show you the numbers. I'm going to take this analysis and convert everything to reais. So let's start with the discount rate in reais. To convert the discount rate to reais, all I had to do is take the cost of capital, 8.46%. Remember that little trick we had? No, you give me the inflation in Brazil, inflation in US, I can convert a dollar cost of capital to real cost of capital. 15.91%, much higher cost of capital in real terms. But remember, all my cash flows are in US dollars. I need to convert those cash flows to reals, not just for this year, but year 1, year 2, year 3, which means I need exchange rates, not just for today, but for year 1, year 2. You cannot use today's exchange rates and get away with it if you have different inflation rates. So I'm going to use a very simplistic, it's called purchasing power parity, way of forecasting exchange rates. Here's what's going to happen to the dollar-real exchange rate over time based on purchasing power parity. The inflation rate in Brazil is 9%, the inflation rate in the US is 2%. The real is going to depreciate about 7% every year. I built that in. So my expected exchange rates are going to reflect the same inflation difference that I have in my discount rate. So inflation affects my exchange rates, inflation affects my cash flow. Let's see what the end product is. So I've taken my dollar cash flows, I project out exchange rates, and notice that based on the difference in inflation, you go from 2.35 reais to 4.56 reais over the next 10 years. That's what a 7% difference will do, is the real will depreciate over time. Use those expected exchange rates, my cash flows become real cash flows. I discount them at the 15.91% cost of capital. And here's the magic. The net present value that I get is 7,745 million reais, which converted back into dollars gives me exactly the same net present value as I would have had if I'd done everything in dollars. This is incredibly good news. You know why? If you're asked to do a project analysis, don't sit there like Hamlet saying, which currency should I use? Going back and pick a currency, stay consistent. I give you a Russian project, you don't want to deal with rubles, do everything in dollars. As long as you stay consistent, you will get the same net present value. If you switch currencies and do it in a different currency. If you are not consistent, all bets are off. Tell me some of the ways in which inconsistencies can creep into valuation. You know what about a third of all companies do when they convert cash flows? They take today's exchange rate and they use it as the expected. They say, I don't know what the exchange rate will be, so I'll just use today's exchange rate. What is that going to do? If I use today's exchange rate to convert all these cash flows, what will happen to my net present value in real terms? Is it going to go down or go up? It's actually going to go down, because now what's going to happen is my numerator has an inflation rate of 2% built into it. It's really dollar cash flows. They're really not real cash flows. I'm discounting it back at a discount rate that reflects a 9% inflation rate. I will destroy my valuation. So watch out for inconsistencies, but if you're consistent, not a big deal. So let's step back. I gave you revenues in the project. Remember, I was the bottom person on the totem pole, so I had to do all the number crunching. And I made up some stuff along the way, right? Made up is probably too strong a word, but I based it on theme parks in the US, theme parks in Europe. Or put simply, every number that I'm using is an estimate, right? The revenues, the expenses, the tax rate. I can't think of a single number here that's a fact. Maybe the T-bond rate, but even that is a maybe. Everything is an estimate. Could I be wrong? That's a stupid question. Of course, you are going to be wrong. So when you do a project analysis, never ask the question, could I be wrong? Yes, you are wrong. You're wrong 100% of the time. You know why? Because you're not God. The future is going to bring uncertainties. And if you sit there worrying about the fact that you could be wrong, question is, what do you do? So I'll give you the choices. There's a lot of uncertainty in this analysis. Which of the following would be your preferred response to uncertainty? One is, you'll wait for the uncertainty to pass. How long are you going to be waiting? Probably forever. You think companies don't do this? Right now, projects have come to a standstill probably around the world. You know what they're waiting for? The banking crisis to pass. Guess what's going to come after the banking crisis? Some other crisis, and then some other crisis. We lurch from crisis to crisis. You said, I'll just wait for the Russian invasion to end. It doesn't look like it's ending anytime soon. So you might be waiting another decade. So that's really not a choice. Maybe you will not take the investment, in which case, what's going to happen to your company over time? You're going to end up as a money market fund and liquidate yourself and go out of business, right? This is I'm sure across the country today, this is already happening. You know who First Republic called in yesterday to read the news stories? I think it was Boston Consulting Group or Bain. One of the big consulting firms. Why? As if, let's face it, Bain or Boston Consulting Group doesn't have any idea what's going to happen in the future either. This way, if they screw up, they can always say the consultant told me to do this. That's a great, it's in fact the biggest reason for consulting to exist as a business is to pass the buck, right? Let somebody else be responsible for it. Ask a third party. Or maybe you're one of those very unusual human beings, but this completely doesn't faze you. In which case, you're probably closer to being a psychopath than a normal human being. Normal human beings worry about uncertainty. Psychopaths worry about nothing. You know that there are actually studies that have been done which look at the brain patterns of people who are psychopaths and brain patterns of people who are really good at trading, because in trading, you got to have this mindset of completely being oblivious to what's going on. And I don't mean to argue that traders are psychopaths, but the brain patterns are remarkably similar. That's the kinds of mental skill sets you need to kind of be able to be oblivious to uncertainty are exactly the same kind of mental skill sets you often need to not care about killing 15 people. Jeffrey Dahmer, if he hadn't gone into eating people, would probably have been a really good trader, right? So if you think about what to do, so I'll give you my responses because I value companies, I do projects, uncertainty worries me, and that's a good thing. I mean, I don't want to be a psychopath. So let's look at the ways in which people have dealt with uncertainty. 30 or 40 years ago, when you didn't have all the tools we had, one of the things that people would do after they did net present value is compute what's called payback. What does payback measure? Remember the big thing that Disney worries about is the big investment that this, $5 billion, Tesla is going to invest $20 billion in the robot business. At the minimum, you want to at least get your money back, right? I know it's nice to make a return, but at least you want to get your money back. Payback measures how many years it will take you to get your money back. It's very simple. You just add up the cash flows. And in this case, it takes about 17 years for Disney to get, it takes about 10 years for Disney to get its cash flows back. If you just add up the cash flows to see when your initial investment comes back. But that's just your cash flows. But we've argued cash has a time value. So if you look at the discounted cash flows, it takes them about 17 years. Say, what do I do with that? Companies often have constraints on payback. They will not accept a project if the payback is greater than 5 years or 10 years. And there's a logic sometimes. If you're a technology company, you know why you set the payback at 3 to 5 years? Technology changes too much. So you don't want to go into a project saying my cash flows in year 13 will cover what I'm investing today. It's often an add-on to net present value or IRR, where you use it as a constraint saying, I will accept projects with a positive net present value as long as the payback is less than 5 years, 10 years, 15 years. So payback is a way of risk adjustment you're doing because you don't have any other tools. Here's the second thing you can do. And this is clearly much more doable now than 40 years ago. I'll tell you how difficult it was to do to ask what-if questions after an analysis. In the summer of my MBA, and I'm going to give away my age, summer of my MBA was 1980. The economy was in a recession. I was looking for a job, and I found a job at a company called Watermark, this tiny little company in Studio City, California. So I went to UCLA. So I go to the company. They had one product. A show, a 4-hour radio show called American Top 40. It's still around. If any of you drive across the US on a Sunday, it's still around. It's American Top 40. It's an incredibly creative show. You know what the show is? It basically takes the top 40 songs of that week, starts with number 40, goes number 39, number 38, no surprises. But there's always this chatter in the middle where somebody's done research. They can say the singer has 2 spouses or 3 houses or had a car accident, something to keep it interesting, to stretch it out over 4 hours. At that time, the DJ for the show was a guy called Casey Kasem, legendary disc jockey. And the show made a lot of money. The way the show worked was they made the show every week in Studio City, and then they sent tapes. Remember, this was 1980. They sent tapes to radio stations who would pay $1,000 a week for the show. And there were 500 stations that got the show every week. So that's a lot of money, 500 times 1,000, 500,000 multiplied by 52 weeks. But they were a single show company. And they decided that they needed a second show. And this is where I come in. The show they were considering was a show called Soundtrack of the 60s. And here's what they were going to do. They would take a week in 1980, go back 20 years to 1960, and guess what they did? They took the top 40 songs in that week. So you can see how incredibly creative they're being. And for at that time, older people, older, they were listening to the 60s. The 80s was contemporary music. So already you can see it's a different point in time. And they were going to find, they found this disc jockey called Murray the K, another famous disc jockey from I don't know which city. And they were trying to decide, should we produce the show? So they hired me as, like a 6-week internship. So can you come in? And I'd taken one corporate finance class. So I said, I can do this. It's cash flows, discount rate, net present value. It's a big deal. I walk in and I don't even have a place to sit. That's how small the office is. So I kind of hang around. And the CFO is a cubicle, not even an office. So I go to him and say, where are the cash flows? He said, what cash flows? He says, for the show you're going to do. He said, we have nothing. He hands me a ledger sheet, nothing on it, big sheet of paper. And said, that's your job. For the next 6 weeks, you have to come up with all the items you need to come to the cash flows. I said, that can't be that difficult. You're, say American Top 40, you have 500 stations, you charge $1,000. All I need to know is how many stations you can sell the show to. I have no idea. So he said, go ask the marketing chief. He sits in the next cubicle. I go, and that guy hates me from the moment I walk in. Why? He's a creative type. You've run into these in your jobs, right? They're creative type. They just don't like numbers people because they view them as constraints on their big decision-making. So he acts like I'm not even there. And after about 3 days of him ignoring me, finally I said, look, I need to get started. How many stations do you think you can sell the show to? I said, I don't know, 200, 300, 400, something like that. And I know this is all I can get out of this guy. So guess what my base case number of stations was to get my cash flows? 300 stations, 200, 300, 400, might as well go with the middle number. And this is how I built the entire spreadsheet. So 6 weeks later, it's a climactic moment. I got the cash flows, I come up with it. I don't even remember how I came up with the discount rate. But I come up with the net present value and it's negative. So I said, look, I go to the CEO, sits in another bigger cubicle. And he calls 2 directors who seem to be hanging outside. They come in and they sit around a table and say, tell us what you found. And I go through it and I say, I hit them with this climactic conclusion. This is a terrible investment. You shouldn't be taking it. The net present value is negative. And I sit back expecting applause. They look at each other and they say, what would happen if you tried 400 stations? Stomach dropped. Because this isn't an Excel spreadsheet where you change 300 to 400. To do 400 stations, you know what I'd have to do, right? Every number in that. That's what I learned. Never do these ledger sheets in pen. It's a horrendous mess. 400 stations meant going through every single cell. And I said, why would you want me to do that? They said, we've already decided to do this project. We just want you to confirm it's a good idea. At that time, I thought it was a small company. They were not sophisticated. 40 years later, I've concluded that this is the way of the world. People decide what to do, then they will look for a confirmation. And if you're the number cruncher, they will keep coming back at you until you confirm what they want you to tell them. It's not the way the world is supposed to be, but it's the way the world is. Today, it's much easier to ask what-if questions, right? In fact, within your group, there's probably this one person, pain in the neck. So what if this? What if that? What if interest rates go up? What if Jerome Powell catches a cold? So what if, you ask, and this doesn't stop. You can ask what if questions about every single assumption. So I'm going to put a limit on how many pages your case can be. So let's limit it at what? Is there a limit already online? If there's no limit, keep it to at least 10 pages or less. I put this limit in as long as the case has been written. But I remember about 7 or 8 years ago, I put this limit and I get one case back with 110 pages. Sticks out like a sore thumb. Pick it up. They've run 105 scenarios on the project. I think this is good. They're asking the right questions. In 55 of them, they got a positive net present value. In 50, they got a negative net present value. They get to the last page, and here's their conclusion. If you know you're going to be in a positive scenario, take the project. If you think you're going to be in a negative scenario, don't take the project. Thank you very much for letting me know. Why did you even bother doing this analysis? But you can see that, no, sometimes we think asking what if questions allows us to converge on a decision. But I found that asking what if questions often makes you more confused than you were before you started 3 hours. So a couple of pieces of advice. One is less is more. Pick 1 or 2 big assumptions and ask what if questions about them. Don't get carried away. And second, if you can present your results in a picture rather than 15 tables, do so. I'm not digging through 15 tables with 10 rows apiece, looking for a number that makes sense. And if you want to find a really good book on, let's face it, Excel is terrible at pictures. It's easy, right? Insert chart. I've seen people have 2 numbers, insert chart to show me 2 numbers. No, I can see 2 numbers myself. You know, I don't have to show big bar, small bar, 100, 45, 100 is greater than 45, but insert chart is so easy to do. So if you want a really good book on picturing data, there are actually companies now that do it. Tableau is one of those companies, does it well. There's a book by a guy called Edward Tufte. I think he's a Princeton professor. His specialty is the visual display of information. In fact, that's the title of his book. And in that book is one of my favorite pictures of all time. It's a picture of the of Napoleon's attempt to invade Russia in the 1800s. So let's set up some history. Now, European monarchs seem to have this fixation with invading Russia over time. Why? Because it's there, it's big, let's invade it. So one day, Napoleon wakes up and he says, I want to invade Russia. Why? No, who knows why people make up this. So he gathers this huge army. See this broad line? That's the army that he's gathered. He leaves Paris. Lots of pomp and ceremony. Napoleon's probably riding on a horse. Everybody else is walking. And they move through. So there he is going through. You're saying, what are these tangents? He gets distracted. He's going through Poland. He said, let's invade Poland. It's on the way. And he sends off a little branch. But there's the army marching through. Notice that the breadth of the thing, that's the size of the army. You're saying, what's happening? You're marching from Paris to Moscow. You're not doing this in 2 days. It's happening over months. And if you've ever been in Eastern Europe or in Russia in the winter, don't want to go back there. It's really cold. So people are dying. So but he keeps going. There he's in the outskirts of Moscow. So that's the light brown line. That's where he's. In fact, if you go to Moscow, there's actually this place where supposedly Russians stopped the French army. It wasn't the Russians stopping the French army. It was the Russian winter stopped the French army because he gets to that point right outside Moscow and he says, it's really cold. I want to go home. So there he is going back home. Notice what's happening. By the time he gets back to Paris, it's 3 guys carrying Napoleon back home. And in one chart, on this axis, you actually have the temperature dropping as you're going by. This is a great chart. It shows you what would have taken you 100 pages in a history book to show. And the guy did it all by hand. What I'm trying to say is it's become easy to churn out charts that are not creative, right? And Excel does that really well. But I think we need to think about creative ways of presenting information because people don't have time to go through 15. Even if they have the time, they don't have the inclination. So try to do it in a way in which it captures the attention of people. So that's the second way, is asking what if questions, and it's become easy. There's a third way, and it's one that 30 years ago was not feasible. You know what a Monte Carlo simulation is? You heard of a simulation, right? If you haven't, let me back up. In my original analysis of Disney, I made estimates, but I made what I call point estimates. What does that mean? I made an estimate of the number of people coming to the park, the revenues, the margins, but they're all single numbers. But if you think about the reality, when I say that, the costs are going to be 60% of revenues in the theme park, I don't know for certain it's going to be 60%. It could be 56, 54, 52, 40. So there's a distribution. I gave you the most likely number. In a Monte Carlo simulation, instead of giving me a single number, you give me a distribution. In the case of the Disney theme park, what if instead of giving you just the revenue, I said, you know what, there's the revenue, but I could be off by 20% on one side. In other words, my actual revenues can be 80% of my projections or 120%. This is called a uniform distribution, which basically means I have no idea where it'll fall, but somewhere between these two numbers. The operating expenses, I've given you a base of 60%, but that's from Orlando. I say, you know what, Rio could be more expensive, less expensive, I have no idea. And I give you, this is called a triangular distribution. It's also symmetric, which means it's centered around the middle. What's the most famous symmetric distribution that you run into over and over again? The bell curve normal distribution. This is kind of a variant of that because you cap both sides. And for the country risk premium, Brazil could get riskier, it could get safer. I've allowed that to be a distribution. So here's what happens in a simulation. Rather than look at one number, I go into each distribution, I pluck out a number. So let's say the first number I pluck out is 110%. I use that 110% of revenues, giving me higher revenues. I get an expense, I get a country risk, I compute a net present value. And I do it over and over and over again. Sounds like a lot of work. In fact, the way I was taught simulations is the professor brought in glass jars with papers, the numbers written in, pulled the paper out, dropped it back in. Thank God we don't have to do that anymore. In fact, at Stern, we have access to a program called Crystal Ball. You get a chance to try it out. It's an add-on to Excel. It's an actually extraordinarily neat program. I love playing with it because you take an Excel file, you valued a company, done a project. If you add Crystal Ball, it allows you to take your inputs and make them into distributions. And what you get as output is a net present value, not one net present value, but a distribution of net present values. And you can see my base case, if you look across all of the net present values, my median net present value is 3.28 billion. Do you remember what my net present value was when I just did a point estimate? But 3.2 billion, you see all this work to get you should get roughly the same number, right? Because the distributions are centered around my base case assumptions. But what else do you learn when you do a simulation? I've never understood when people do best case and worst case scenarios. I'll save you the trouble. In the best case scenario, your project is worth a lot. In the worst case scenario, it's crappy. Let's get that out of the way. Is the best case and the worst case here? It's in the distribution, right? The best case scenario is this project could add about 9 billion in value. The worst case is it could have a net present value of minus 1 billion. Now, when you take a project, what do you worry about? What is the likelihood that I'm wrong? Remember, we talked about sunk costs. What is the chance that I'm going to have regrets after this? If you look at the net present values, which are less than 0, 12% of the time, I get net present values less than 0. Think of how much richer your decisions can be, because I'm not just giving you a number, NPV. I'm saying this is your median, this is the distribution, this is the chance that your net present value can be negative. You still have to make the decision, but you can base it on a much richer set of information. Try it out. As I said, download it. Do it. In fact, if you decide to buy Crystal Ball, do it while you're a student. It's only $100. Because once you graduate, it's like $750. It's still worth it. I don't know why, equity research departments and consulting firms don't make this part of the toolkit. The only thing that you have to remember is it will still ask you, once you get to an input, to pick a distribution. Let's face it, our statistics classes are designed to make us not want to use statistics ever again in life. And most of us, if you asked us, if you're asked, what distribution do you remember from the class? We're very close. You know why we like the normal distribution? It's nice and symmetric. It's normal. You're normal. So let's pick something that's normal. But if I say, what does exponential distribution look like? I have no idea. What are you even talking about? So if you're going to use crystal ball, one of the piece of advice I would have is, at least get a quick review of symmetric versus asymmetric distributions, log normal versus normal distributions. You go to my website, I have like a 15-page, very quick review of everything you might need to know about distributions before you decide to jump into crystal ball. Because garbage in, garbage out, you can get great looking garbage, but if you don't understand distribution, it's going to be very difficult to use simulations. So net present value is negative 12% of the time. Let's stay on that fact. So let's say you're remember, it's back to you now. I've given you all the information. You're sitting there, what do I do? There's a 12% chance this project will have a negative net present value. So it's not certain that you're going to create value. Would you accept the investment anyway, even though there's a 12% chance, and print the results of the simulation, put it in a folder and show, so later on somebody comes and says, why do you pick this bad project? And say, due diligence, look, I turned out 50 pages. That's your first choice. The second is, you should reject the investment because you want a slam dunk. And the third is, maybe there's something else you can do with the simulation that will be more productive. You know what most people do? First, it's just covering your rear end. The only reason for all the what if analysis is not to make a better decision, but to show, look, I tried. It's not my fault. If you reject this project, I think you're double counting risk. Why? What did you use as your discount rate? The cost to capital, right? What went into a cost to capital? Your risk premiums and the risk in the project. You've already punish the project for risk. And now to punish the project again, because 12% of the time your net present value is negative, is double counting. But here's the most productive use of net present value. The 12% of the time when your net present value is negative, it's because of some factor, right? Some cost that is fixed. In the case of Tesla, it might be the fact that your G&A cost is a fixed cost. If there's something you can do as a company to make that cost variable, to make it more reflective revenues, maybe the 12% can become 5%. The best use of Monte Carlo simulations, not just to take the project, but to frame the way you run the project to reduce the likelihood of the negative net present value. So that's all I'm going to say about the theme park. Review it. We did a lot of stuff, but basically it gives you the framework for a standalone project. 10 years ago, a big theme park investment would have been the biggest investment that Disney was making. And of course, in the last 3 years, if you look at where Disney has spent its money, it's not on theme park, it's not on movies, it's on Disney Plus. Disney Plus, of course, in it. And this is the reactive effect of Netflix. Let's be quite clear about this. Netflix has changed the entertainment business, I think, for the worse. It's changed the economics of the business. Other companies had no choice but to be like Netflix. So Disney Plus was, of course, their attempt to say, we can out Netflix. And if you remember, the show that allowed Disney Plus subscribers to take off was The Mandalorian. And what was different about the show, what allowed it to be successful, was it was not just a TV show. TV shows are usually lower budget than movies. This was a TV show with movie production quality. It cost about 15 to 20 million. WandaVision, I think, cost, another 20 million a piece. These, and if you think about 8 or 10 episodes, you're spending as much money on a show for Disney Plus as you are on a big budget movie. An Avengers movie probably costs about the same as creating a 14-episode version of the Daredevil. So I'm going to frame this as a question. Let's assume that there is this new show you're planning to make for Disney Plus. Why? Because the way I describe Netflix, it's like a hamster on a wheel. You cannot get off because once you're trapped in this, and this is a problem that Bob Iger is going to have, is your users expect new shows. Right? Otherwise, it's subscription based. So they're going to have to come up with bigger and more expensive shows just to keep their subscription base going. So let's say they decide to go with, let's take the Daredevil show, 14 times 20 million, that's 280 million. He's saying, well, how do I assess the net present value of this investment? So we know how much you're spending, right? That's the easy part. What are the benefits? traditional movie, you counted gate receipts, maybe, no. But here there are no gate receipts, right? You're going to offer them to Disney Plus subscribers effectively for nothing. This sounds like a terrible idea, right? You spend $280 million, you get nothing. Or is it nothing? Or what do they hope that the show will do?
Sure.
Lower churn rate. One, you know what a churn rate is? A percentage of subscribers who renew. So if you can lower the churn rate, can I quantify what that will mean in terms of cash flow? So if I lower the churn rate from 10% to 5%, I can say that translates into $8 million a year in additional subscription fees. So that's what. What else would they be hoping for? What did The Mandalorian do? Allow them to add new subscribers, right? So maybe there are people who are not part of Disney Plus who love the first Daredevil. It's 4 seasons. I loved it on Netflix, and I've been waiting for this to come out. And they might add on. So there might be new subscribers added on. But basically, you can already see it's a much trickier thing to do in terms of estimating. So you know what Netflix does, right? It doesn't do any research. Basically, it produces shows, throws it against a wall, hopes something sticks, and then wonders, why are we spending $30 billion in content and nothing's happening? It's a terrible business model. It's not the way the entertainment business was designed to be run, but you're now at the mercy of it. So it's I think, the biggest problem with the streaming business is doing traditional project assessment. And Disney was very good at this on movies and their traditional shows. They can't do that anymore in the streaming business. And Netflix doesn't know how to do it either. It's not like they've mastered it. So I think this is something that needs to find some substance if the streaming business is going to find its legs. It'll happen sooner or later. But that's basically what, and we're getting the data to help us. Maybe that'll allow us to come up with ways of estimating the cash flows from these shows. But right now, I don't think you can come up with an NPV assessment because many of these numbers you learn after the fact. If you ask Disney, can you assess what the effect will be on the churn rate of producing the show? People don't have the capacity to do that well as of right now, but they will as they learn more about this business. Somebody had a question, yes.
Would you also consider like other form of revenue?
It could be if you can get merchandise. Remember, when I was in Disney World, Baby Yoda is still selling like crazy. There was a Christmas where Baby Yoda was the biggest seller. So there's the merchandising business, and you're going to bring that in as well. So the problem is Daredevil doesn't lend itself very well to merchandise. Unfortunately, maybe some plus, you could create characters, but to the extent that is merchandising, Disney will find a way to do it. Trust me. But that should be part of the cash flows as well.
How do you make the decision from going from season 1 to season 2?
Hamster on a wheel. Yeah, which is unfortunately what the streaming business is, which is it's almost completely arbitrary. You notice this on Netflix. Sometimes you see a show drop and say, why did that happen? I love that show. Who knows what data they're using? Right now, the streaming business is a mess. And it's a mess because it's a young business. We don't know how the subscription business really works in terms of value added. So right now, the answer is they don't do it very well. So some shows run for Stranger Things might run for multiple seasons and it's well-deserved, but there's some other show you look at and say, why the heck is that being renewed for another season? Yeah. So right now, I think it's because the statistics are so bad on the benefits of these shows. But at least on traditional TV, how did they decide whether to renew a show or not? Why was it easier on the old TV? What did they look at? It's ratings, right? Advertising, because your advertising revenues were tied to your ratings. So there's a much closer connection between shows and what they provided for their producers. With streaming, you don't have that. Unless you created some ad. And that's the other reason Netflix might be experimenting with an ad-supported version is there you can actually quantify the revenue effect because it's advertising revenues. I know we're at the very end, but next session when we start, I'm going to look at a third project. And it's going to be an iron ore mine for Vale. But I'll set up what I'm going to do. Instead of doing in Disney, I looked at everything prior to that, right? Operating income, cash flows. I used the cost of capital. I came to the net present value. With the iron ore project, I'm going to be looking at the project through equity investors' eyes. What does that mean? I'm going to be able to return on equity rather return on capital, I'm going to compare it to a cost of equity. When I do my cash flows, they're going to be cash flows after debt payments, cash flows to equity. I'm going to discount the cost of equity, and I'm going to come up with a net present value based on it. It's the same principles, but it's a different vision of the same project. So when we start on Monday, we're going to look at an equity-focused project analysis, why it's so critical to stay internally consistent. So that's it. See you on Monday. Or work on your case before we get back on Monday.
Thank you for having us. We appreciate it.